Tonight, we begin with a regulatory announcement that financial advisors had feared, senior advocacy groups dismissed, and federal analysts prepared for months. A policy shift that unfolded not over years of deliberation, but in a single legislative session. A single session that will reshape retirement planning for millions. A single session that will force immediate action from those least prepared. A single session that separates those who act now from those who will pay the price later. What federal regulators did today crossed a line that the financial services industry had hoped would hold. And when that line broke, seniors across America did not hesitate. They responded with urgency, with concern, and with an overwhelming need for clarity. For 18 months now, there had been whispers, not official press releases, not formal congressional hearings, just whispers, that the Treasury Department was preparing something unprecedented for retirement accounts. Federal regulators have been aggressive, yes, but they have been methodical in their aggression. Their moves have followed a certain logic, a pattern, almost a rhythm. But what set off alarm bells in Washington and financial planning circles this January was that the rhythm went silent. Estate planning attorneys who monitor regulatory filings know the indicators. The preliminary comment periods, the stakeholder consultation meetings, the gradual policy announcements, the sudden withdrawal of draft guidelines. All of that went quiet, and whenever federal agencies go quiet after months of activity, it means something is about to get loud. Early Monday morning, the Internal Revenue Service detected what they described as systematic non-compliance patterns in required minimum distribution calculations, including penalty structures that had not been updated in over 15 years. These are the kinds of enforcement mechanisms that the IRS only activates when they are signaling something very specific: increased scrutiny, expanded audits, or comprehensive policy overhaul. Financial observers didn't know which category this fell into, or whether it fell into all three at once, but what they did know was that the federal government was changing its posture toward senior retirement accounts. And when regulatory bodies shift enforcement strategy without extensive explanation, even by small measures, financial institutions pay attention. The guidance issued by the Department of the Treasury tonight was not normal. It was not routine. It was not symbolic. It was urgent. Conference call after emergency briefing described the new regulations as comprehensive in scope, immediate in implementation, and perhaps most importantly, retroactively enforceable with significant financial consequences. But regulatory pressure only works if the target hesitates. Informed seniors did not. In fact, their response today was among the most significant mobilizations we've seen in retirement planning history. Here's what we know. Within 72 hours of the announcement, seniors and their advisors initiated emergency portfolio reviews. These weren't the standard annual checkups. These were comprehensive compliance audits, strategic sessions that financial planners only schedule when they are preparing to protect assets from substantial penalties. Tonight, financial industry sources confirmed that the new regulations target 3 specific areas affecting seniors 60 and older, including distribution requirements that had recently been relaxed for what analysts believe was temporary pandemic relief. The Treasury Department moved before seniors could adjust their long-term strategies. They hit traditional IRA holders. They hit 401k beneficiaries. They hit inherited retirement accounts that were likely preparing to transfer wealth to the next generation. In other words, regulators targeted the structural foundation of multi-generational wealth transfer, the planning strategies that would have made tax-efficient inheritance operational. This is what made the Treasury's warning so urgent. The regulatory change wasn't just symbolic, it was actionable. It represented the kind of move that could cost families hundreds of thousands of dollars if left unchecked. And financial advisors, understanding that fully, responded with force, not recklessly, not impulsively, but strategically. They didn't panic clients into poor decisions. They didn't recommend hasty account liquidations. They hit the compliance requirements head-on. They hit the planning windows that still remain open. And here's where the story becomes even more consequential. Tax policy experts now believe that the Treasury's latest move was designed to test the responsiveness of seniors after years of delayed enforcement during economic uncertainty. Regulators wanted to see whether retirees would ignore new requirements until penalty notices arrived, but instead, the opposite happened. seniors and their advisors didn't wait for clarification. They launched immediate compliance reviews that were so thorough, so proactive, that even IRS officials noticed the surge in corrective filings. You don't get the Treasury Department's attention easily with voluntary compliance, but today, informed seniors did. Certified financial planners speaking with industry publications under anonymity described the regulatory shift as strategic repositioning, a way to recapture revenue while appearing to close loopholes. But prepared seniors proved today that they remain both informed and mobile with their assets. Their portfolio adjustments were not only swift, they were executed so precisely that financial institutions reported record volumes of account rebalancing requests. That precision matters because it shows this isn't panic. It shows that seniors are not passive recipients of policy changes. They are active protectors of their financial futures. As reports continued coming in throughout the week, we learned more about the scale of the regulatory impact. Major brokerage firms carried out emergency client notifications, forcing thousands of strategy sessions before the compliance deadline. Tax preparation services targeted account holders that had been restructuring inherited IRAs in the last 24 months. Estate planning attorneys operating nationwide reportedly revised trust documents used by families to transfer retirement wealth across generations. This wasn't just a minor rule adjustment. This wasn't just updated guidance documentation. This was comprehensive regulatory restructuring. This was wealth preservation under time pressure. And wealth preservation under deadline is the one thing seniors have struggled to maintain since the Secure Act of 2019. For every planning advantage they have secured, new regulations have countered with something that complicates the strategy. Remember, seniors thought the 10-year distribution rule was settled policy. They thought inherited IRA strategies were grandfathered for existing accounts. They thought required minimum distribution ages were stabilized at 73. But tonight, the exact opposite is happening. Annual distribution calculations are being recalculated retroactively. Penalty assessments are being applied to previous tax years. Compliance windows are closing faster than most people realized existed. What makes this moment so urgent and so financially significant is that the Treasury's latest move happened at a time when seniors are under unprecedented cost of living pressure. Healthcare expenses want larger portions of fixed incomes. Inflation adjustments want to erode purchasing power. Family support obligations want financial assistance for younger generations. Long-term care planning want substantial reserves set aside. Seniors are balancing these demands while navigating the most complex tax code in American history. And when regulators in that environment make sudden policy changes, they're not doing it from a position of helping retirees. They're doing it from revenue pressure. They're doing it from budget necessity. The Treasury Department's guidance bulletin, now distributed through financial institutions nationwide, was designed to signal that federal authorities are not willing to allow continued tax deferral strategies that reduce government revenue. IRS officials said plainly that previous distribution planning was inconsistent with congressional intent regarding retirement account taxation. That is bureaucratic language for the strategies you've been using are about to become very expensive if you don't change them immediately. You don't usually hear that tone from the Treasury Department unless substantial revenue collection is at stake. Meanwhile, the National Association of Senior Financial Advisors addressed its membership in a sober, direct communication tonight. Their director said, "The window for proactive compliance is measured in weeks, not months." She said, "Penalty structures carry compound interest that accelerates faster than most clients understand." And she said, "This is not the time for wait-and-see approaches to retirement account management." These are not rhetorical flourishes. These are statements from professionals that understand just how high the financial stakes have become. Here's what makes the situation even more concerning. The Treasury's latest move wasn't isolated. Along with the primary IRA and 401k changes, state tax authorities also updated conformity rules to match federal requirements. Medicare premium calculations incorporated new income thresholds based on distributions. Social Security taxation increased for seniors whose required withdrawals pushed them into higher brackets. All of this happened within the same regulatory cycle. When federal agencies move multiple policy pieces at once, it means something larger is underway. Financial analysts are now considering several possibilities. One is that regulators are preparing for broader retirement account taxation reforms in the next legislative session. Another is that the Treasury is attempting to accelerate revenue collection before potential future tax law changes. A third possibility, the one worrying estate planners the most, is that regulators are attempting to fundamentally reshape how wealth transfers between generations through retirement vehicles. But today, informed seniors took control of the situation. They didn't ignore the new requirements. They didn't assume extensions would be granted. They didn't wait for political intervention. They acted immediately to protect their assets. What we're watching now is a test of financial preparedness. Regulators want to see who will comply voluntarily versus who will face enforcement. Seniors want to show they can adapt faster than bureaucrats expect. Financial advisors want to prevent catastrophic tax consequences for their clients. And families want to prevent the erosion of generational wealth they've spent decades building. Tonight, we've heard from compliance specialists who are now working extended hours to process the volume of requests. They say account restructuring consultations have increased 340% since the announcement. They say penalty calculation inquiries have overwhelmed normal service capacity. And they say the Treasury's decision to implement immediate enforcement is likely part of broader deficit reduction initiatives intended to increase federal revenue without raising statutory tax rates. But prepared seniors are not waiting for penalties to arrive. In fact, prepared seniors are taking decisive action now. Their response today, swift, strategic, and comprehensive, sent a message to regulators that this demographic understands financial consequences. And it sent a message to the financial industry that seniors demand clarity, support, and immediate access to compliance solutions. As the compliance period continues, we expect more details to emerge about what exactly the Treasury hoped to achieve with such aggressive timing. But what we do know is that early action is essential. It prevents penalty accumulation. It preserves wealth transfer strategies. And it protects families from unnecessary financial hardship. What happens next will depend on what seniors do in the next 30 to 60 days. If they act now with qualified advisors, this moment will be remembered as a manageable transition. If they delay, the Treasury Department has already shown they are prepared to enforce aggressively. They have shown they are ready to collect penalties. And tonight, for the first time in years, the retirement planning landscape appears to be fundamentally shifting. The regulatory environment is changing too quickly for comfort. And when federal agencies move this fast, it means they are committed to a new enforcement paradigm. It means they are choosing revenue collection over taxpayer convenience. Because tonight, millions of American seniors learned something they should have known all along. Regulatory compliance windows close without warning, penalty structures compound without mercy, and early action is the only protection against financial consequences designed to extract maximum revenue. This story is far from over. But tonight, one thing is clear. Seniors who act early will preserve their wealth. Seniors who delay will pay substantially more. And the difference between these outcomes will be measured in tens of thousands of dollars per household. And we will be here watching every detail as the next phase unfolds.